Hi, this is Joe Elsasser, President and founder of Covisum and also a practicing financial advisor. And welcome to another FinPlan Friday. Today's topic is Social Security in 2022. Now, 2022 is going to be an interesting year. You've probably seen the headlines that a 5.9% cost of living adjustment is going to apply to all beneficiaries. Now, that's really interesting because last year's trustees report, which by the way was the latest report issued in the history of the system, even counting for changes to the fiscal year that have happened in the past, projected only a 3% cost of living adjustment. Now, with recent comments from the Fed chair suggesting that this inflation may not be transitory, it will be really interesting to see what the next Social Security trustees report holds. And under normal circumstances, those reports tend to be issued sometime between February and May. So that's what I would expect for next year. Now, when that trustees report comes out, if there is a significant change to the inflation assumption, either in the near term or in the long term, it's quite possible that we'll see Social Security depletion dates move forward. Now, this year's trustees report, the 2021 trustees report, suggested that the pandemic's impact on Social Security would move forward the depletion date for the Old Age and Survivor Insurance Fund by just 1 year, from 2034 to 2033, and after which point the ongoing tax revenues of the program would be able to support roughly 76% of ongoing promised benefits. But, of course, the headlines didn't say all of that. The headlines said Social Security will be broke 1 year sooner. Now, if we get into next year and we have a significant change in the inflation assumption, it's quite possible that we'll see a depletion date that moves forward yet another year, so moving from 2033 to 2032. If it's a really significant and long-term adjustment to inflation, we might even see it move 2 years, particularly if there are other assumption changes in that report having to do with payrolls, effectively the Great Resignation, people not returning to work. So it's quite possible that we will see Social Security depletion dates move forward by another year in next year's trustees report. And that's going to be really important for financial advisors to prepare their clients for in advance. And if not in advance, at least to have a mechanism for handling it at the time we start seeing those headlines. Because I promise the headline will not say 76% of benefits will continue to be payable by then current revenue. Instead, the headline will say Social Security will be broke a year sooner. And the kinds of questions you'll be fielding are questions like, shouldn't I claim early since Social Security is going to be out of money? Now, in most cases, that does not make sense. Claiming early out of fear does not make sense. But how can you convince a client of that? It's really simple, actually. Do the math. In the same way that common knowledge used to be claim Social Security early and invest it, that changed. At the point that people sat down and actually calculated the value of different Social Security strategies, it became really apparent that for most people, claiming early is not the best decision. And that continues to be the case even under a benefit cut scenario. So that's step one, is do the math for a given client. Now, Social Security timing enables you to do that very simply. It allows you to identify both an earliest and an optimal strategy under the current Social Security rules. And then it allows you to apply a benefit cut scenario to ensure that even under a benefit cut, that scenario, that optimal scenario, still works out better for the client than claiming early. So that's step one, is really stress test the Social Security decision under a benefit cut scenario. Now, step two is what's the impact on the client's overall plan, their ability to achieve their goals throughout retirement. And that you need to do really in your financial planning software because it's going to impact how you utilize all of the other client's assets. Now, if you're using one of the primary financial planning tools out there, there are a variety of ways you can attempt to model that. For those who are using Income Insight, you can model that simply by clicking the Social Security benefit cut stress test, and it'll apply the same stress test that was applied in Social Security timing to the Social Security cash flow in the plan, and it'll utilize assets to maintain the client's standard of living throughout retirement, net of tax. And that'll give you the ability to see whether they have the ability to reach their goals even in a benefit cut scenario. Now, if they don't, it might make sense to consider smaller cuts to lifestyle now, or working longer, or finding other ways to supplement income in order to avoid a larger cut later. So those are really the big considerations. As we enter 2022, be mindful of that 5.9% cost of living adjustment, but also be mindful of the impact that it may have on the long-term solvency of the program, and be prepared to talk with clients about how that impacts them, their claiming decision, and their plan in total. Thanks so much, and we look forward to the next FinPlan Friday.